Welcome to TalkTickers. We cut through the earnings call noise to bring you, the experienced investor, the crucial insights.
And today, we're diving into Genpact Limited. First quarter results for 2025 just dropped.
Right, and it looks like, well, a story of strong current performance kind of bumping up against some future uncertainties.
That's a good way to put it. Genpact definitely exceeded expectations in Q1, pretty much across the board.
Okay, let's get into the numbers then. What do they report?
So total revenues hit $1.215 billion. That's an 8.3% jump year over year in constant currency, which is pretty solid.
In earnings.
Adjusted EPS grew by a significant 16% year over year. Came in at 84 cents.
16%, wow.
Yeah, and both their gross margin and adjusted operating income margin also came in better than they initially thought.
So a strong quarter overall, but you mentioned uncertainty.
Exactly. Despite these strong results, the company is actually taking a more, let's say, conservative approach to their full year guidance.
Why the change in tone?
It seems to be down to delayed decision-making from clients in some key end markets. So strong now, but, a note of caution for later.
Okay, so a bit of a mixed picture as we look ahead. Let's dig into what actually fueled that strong revenue growth in Q1.
Well, the company points to really solid execution, bringing new ideas to the table, innovation, and just continued disciplined performance carrying over from last year.
Makes sense. Anything specific stand out?
Yeah, what's particularly interesting is they landed two pretty significant deals in Q1.
Big ones.
Seems so. And they highlighted that over 80% of the revenue tied to these deals is annuitized.
Annuitized meaning recurring revenue, predictable streams.
Precisely. Gives them a good level of predictable income, especially, they noted, in their data, tech, and AI segments. So that suggests their strategic focus there is paying off.
That move towards data, tech, and AI seems key. But then I also heard some talk about big deals getting pushed back.
Yes, that's the other side of the coin. There were a few other very large deals, mostly concentrated in their digital operations area, that got delayed.
Delayed when?
Late March and into April.
And what's the story there? Why the delay?
It looks like it's tied to the sort of ongoing uncertainties around global supply chains and tariffs. That seems to be making some clients hesitate or just take longer to sign off on these big commitments.
The macro environment strikes again.
Seems like it.
And how is this caution, this hesitation, impacting how they see the rest of the year playing out?
Well, because of these delays, Genpact has adjusted their full year revenue forecast. They've widened the range and basically lowered the overall expectations slightly.
To account for slower deal closures.
Exactly. To reflect these potentially longer sales cycles.
Yeah.
Specifically, the outlook for both digital operations and that, previously strong data tech AI segment has been revised downwards a bit because of these specific delayed contracts.
Okay. But it's not all doom and gloom in their forward view, is it? I thought I caught something positive about their pipeline.
You did, absolutely. That's the counterbalance here. Their pipeline for large deals is actually sitting at a record high.
Record high?
Yeah, up over 80% compared to this time last year.
Wow, okay. So the demand is still there, fundamentally.
It really suggests that, yes, the underlying demand for what Genpact offers seems very robust. And importantly, they haven't changed their projections for gross margin or adjusted operating income margin.
Still holding firm on profitability, then.
That's right. And they still expect adjusted diluted EPS to grow faster than revenue for the full year. Suggests they're managing costs effectively, even with the revenue headwinds.
Good point. Now, Genpact mentioned focusing on a 3+1 framework for their strategy. Let's break that down. What are the core elements?
Right, this 3+1 thing. So 4 key components. First up, partnerships.
Okay.
This is proving to be a major growth engine for them. Partner-related revenue saw a very strong start to the year.
How strong?
Jumped 80% year over year. And over 10% just from the previous quarter, it now makes up 10% of their total revenue.
10% already. And they see more room to grow there.
Oh, yeah. They see a lot more potential. They're aiming for partnership revenue to eventually reach levels between, say, 20% and 50% of total revenue.
20, 50%, that's ambitious.
It is, but they point out that's pretty common for more mature partner-driven businesses in their space.
Okay, that's a significant ramp up they're targeting. What's the second key area in this framework?
The second pillar is data tech AI. No surprise there, really.
Given the earlier comments, yeah. How's that performing?
Solid growth. Revenue up 12% year over year in constant currency. But what's fascinating here is the rapid adoption of their Gen AI solutions.
Generative AI.
Exactly.
Right.
The number of those solutions actually in production with clients increased by roughly 50% just in the last quarter.
50%, quarter over quarter. That's fast uptake.
It really is. And their actual Gen AI revenues nearly doubled in that same period. They're also seeing early success, they mentioned, with something called agentic solutions.
Agentic. Like AI agents doing tasks.
Sounds like it. Starting with applications in areas like accounts payable.
Yeah.
And their AI Gigafactory.
Right. Heard that term. What is it?
Seems to be their central hub for developing and deploying AI across different industries. It's now live in manufacturing, retail, and financial services. And they said more industry-specific stuff is on the way.
Definitely sounds like their bets on AI are starting to generate some real traction, some real momentum.
For sure.
Okay, what about the remaining parts of that strategic framework, the 3 and the +1?
Right. The third element is simplification. Basically making their own internal processes more efficient.
Streamlining things.
Yeah. And they say they're already seeing results, like a noticeable decrease in the time it takes them to bill clients, for example.
Always good for cash flow.
Yeah.
And the Perpeto?
The +1 is what they call client zero. It's this idea of Genpact being its own best case study.
Using their own medicine, so to speak.
Exactly. Yeah. Using AI and automation internally to improve efficiency. They've actually reduced headcount in their own IT and HR departments using these tools, which has helped protect their margins.
Interesting.
And apparently their internal AI agents, which they've nicknamed Scout, are also proving to be a pretty effective sales tool. They're generating interest when they show them to potential clients.
Okay, so using internal success to drive external sales. Clever. Let's pivot a bit to profitability and their overall financial health. How did those metrics look in Q1?
Looked pretty strong. We mentioned the adjusted EPS growth of 16% that nicely outpaced their net revenue growth of 7%.
Good operating leverage then.
Seems so. Their gross margin expanded slightly, up 30 basis points year over year to 35.3%. And their adjusted operating income margin saw a really significant improvement, up 120 basis points to 17.3%.
That's a healthy jump in operating margin. Cash flow, balance sheet.
Also strong. They generated significantly more operating cash flow compared to last year, ended the quarter with a healthy cash balance, about $562 million.
And what about shareholder returns?
They returned $93 million to shareholders in Q1 through both share buybacks and dividends. So definitely a focus there too.
Okay, a clear focus on returning value. Now let's circle back to those delayed large deals you mentioned earlier.
Yeah.
Can we get a clearer picture of where these delays are happening, which sectors?
Yeah, they specified these are primarily in the manufacturing, consumer goods, and high-tech hardware sectors.
And often related to?
Often related to supply chain optimization work, which kind of fits with the reasons they gave for the delays.
Right, the global trade and tariff uncertainty you mentioned.
Exactly. They believe that increased caution is affecting how quickly clients in these specific industries are making decisions on these, pretty significant projects.
Okay, so it's about timing uncertainty. Are they getting any indication that these deals might just fall through completely? Or is it purely a timing issue?
Genpact was quite clear on this. They said they are not seeing any signs of clients pushing back hard on price or, worse, canceling the deals altogether.
That's reassuring.
It is. They emphasize these deals are still actively being discussed, and in many cases, Genpact is the only provider being considered their sole sourced.
Sole sourced is important.
Very. It's also worth remembering these are typically large multi-year contracts, often 5 to 7 years, and they tend to have lower initial gross margins compared to the company average.
Lower margins at the start.
Yeah, typical for big transformation deals. So, funnily enough, their delay is actually providing a temporary small boost to the overall company gross margin right now.
An interesting side effect. What's the big selling point for clients on these large deals, especially if margins are lower initially?
A key component is the potential for really significant productivity gains for the client over the life of the contract, often in the range of 30% to 45%.
30 to 45% productivity gain.
Driven largely by the AI-powered efficiencies that Genpact builds into the solution, that's a big part of the value proposition.
Okay, that makes sense. So for our listeners trying to piece all this together, what would you say are maybe the 3 or 4 most important takeaways from this earnings call?
Okay, key takeaways. First, that widening of the revenue guidance definitely signals, a higher level of uncertainty in the current global economic climate, particularly around international trade. That's clear.
Got it. Uncertainty is up. What else?
Second, despite that, the really strong growth we're seeing in their data tech AI business, that 12% growth, the Gen AI doubling, it really highlights that Genpact's strategic shift towards these advanced technologies is working and meeting strong market demand.
So the strategy in AI is paying off.
Seems to be, yeah. Third, that record high pipeline for large deals up 80%. It strongly suggests the underlying demand is still there. It points to significant growth potential down the road, once some of this macro uncertainty hopefully eases.
Potential energy building in the pipeline.
Yep. Good way to think about it. And finally, I'd say their continued focus on managing costs and keeping margins healthy, even while investing in growth like AI and partnerships, that's a positive signal for profitability.
Cost discipline remains.
Right. And maybe one more point. While those delays in the large digital operations deals might slow down near-term revenue growth, they don't seem to indicate, based on what the company said, any fundamental problems with demand for Genpact's core services or solutions. It looks more like a timing issue for now.
Okay, that's a helpful summary. Which brings us to our favorite segment. This is not financial advice.
Definitely not financial advice.
So let's consider these dynamics. You've got the temporary headwinds in digital ops from those delayed big deals, but you also have that record pipeline hinting at future potential, plus the continued strong momentum in data tech AI. With that backdrop, what are some outrageous but plausible trade ideas? Strictly for informational purposes, of course.
Okay, outrageous but plausible trade idea number one. You could consider perhaps a short-term tactical short position on a direct competitor.
Which kind of competitor?
One that's maybe heavily focused on digital transformation projects, but typically deals with smaller average deal sizes. The thinking.
Go on.
The rationale would be that they might face similar delays due to the macro environment, but maybe without the cushion of Genpact's massive backlog of large, often sole-source deals.
Okay, so short, the potentially more exposed competitor. And then
Simultaneously, you could establish a long position in Genpact itself. You'd be betting that those delayed large deals do eventually close, giving them a significant revenue boost in the second half of the year and beyond. Plus, you get the continued strength from their data tech AI segment.
Interesting pair trade concept. Okay, what's idea number two?
Outrageous but plausible trade idea number two focuses on that partnership angle. Given the really impressive growth in Genpact's partner revenue, that 80% jump, and their stated goal of massively increasing reliance on partners.
Right, getting to 20-50% of revenue.
Exactly. So you could explore a long position in a smaller, maybe more niche technology services or solutions company. The key.
What's the key?
Find one that has a particularly strong, well-regarded partnership ecosystem already in place. The idea is, as Genpact gets really aggressive pursuing its partnership strategy, a company like that could become a very attractive acquisition target for them.
Ah, an M&A play based on their strategic priority.
Precisely. A way for Genpact to quickly enhance their capabilities and reach in that partner channel. Again, purely hypothetical.
Understood. Outrageous but plausible. Okay, that brings us towards the end of our deep dive into Genpact's first quarter earnings call.
We've covered the key figures, examined their strategic priorities like that 3+1 framework, and explored some potential implications for you as investors.
And remember, this analysis is strictly for informational purposes. It is absolutely not financial advice. Always do your own thorough research.
Definitely. But we would love to hear your perspective. What are your thoughts on Genpact's revised outlook, the potential impact of these delayed deals?
Yeah, join the conversation, share your insights with the community.
Thank you for tuning in to TalkTickers.
We'll be back with another earnings deep dive very soon.